World War II, witnessing global conflict and the rise of the United States as a superpower.
And by the two most frightful wars in history. The supreme need of our time is for men to learn to live together in peace and harmony.
They all shaped the mind of one of the greatest investors of all time. Warren Buffett uncovered a timeless, simple principle that would become the cornerstone of his investment strategy, propelling him to achieve an astounding 23% annual return over a decade.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
This, Brian, is called diversification.
So this is the return to risk ratio that happens for each one of those. You know, like if I can get zero correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%.
Diversification is a strategy that spreads your investments across various assets with low correlation. For example, stocks and bonds have very low correlation. This approach mitigates the risk of the unknown and safeguards against unforeseen losses. Many of Warren's investments are special deals, guaranteeing him a certain return every year.
Don't pay too much. They can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment.
If we take a deep dive into his investment in Occidental Petroleum, for example, Berkshire Hathaway provided $10 billion to Occidental Petroleum in exchange for preferred stock that pays an 8% annual dividend. The terms of the deal ensure that Buffett receives approximately $800 million annually in dividends from Occidental. This arrangement illustrates Buffett's strategy of securing favorable terms that provide a steady income stream for Berkshire Hathaway. The $800 million dividend payment to Berkshire Hathaway represents a substantial portion of their available cash flow. Additionally, there are provisions that could allow Berkshire Hathaway to convert the preferred stock into common shares of Occidental if the dividends are consistently not paid.
The businesses aren't going to perform better in the future just because you got antsy and decided you had to buy something. We will wait till we find something we like.
Ever wondered how Warren Buffett evaluates the worth of a business or asset? He looks beyond the surface to assess what he calls its intrinsic value. This means he focuses on the true economic value of a company, not just its stock price or market hype. For Buffett, understanding this value involves looking at the company's earnings potential, its competitive advantages, and how well it's managed. He prefers businesses with durable competitive advantages like strong brands or unique advantages which can protect profits over the long term. Buffett also puts importance of buying at a price that offers a margin of safety. This means paying less than what he believes the company is really worth to protect against unforeseen downturns. This is his way of reducing risk when not using diversification. However, he also acknowledges that if the potential reward is substantial, it can make sense to buy a bunch of them.
What they do is they start copying what their dumb competitors are doing. That happens in every business, but it's particularly virulent in the banking business. John Stumpf once said, he said, I don't know why we keep looking for new ways to lose money when the old ones were working so well.
He did with his investment in Japan. These companies are characterized by their extensive and diversified holdings, spanning natural resources, energy, chemicals, metals, manufacturing, retail, real estate, and healthcare. Lastly, Buffett pays close attention to the quality of a company's management. He looks for leaders who are skilled at allocating capital wisely and who prioritize the interests of shareholders. In essence, Buffett's approach to assessing the economic value of businesses and assets is about patience, thorough analysis, and a focus on long-term value rather than short-term market fluctuations. It's a philosophy that has guided his successful investing career for decades.
It isn't very complicated. I mean, you have to decide, A, whether it's a product that is somewhat durable, which I think illustrated, and whether the appeal is universal, which it certainly is, and then whether you have honest and competent management running it, which you most certainly do. You know, Peter Lynch has always said, buy a business that's so good that any idiot can run it because sooner or later one will. Well, we would like to buy a business like that, and then we'd like a terrific guy running it. And we had two terrific people at Coke running it.